Hey everyone, welcome to our special series, 8 Investment Tips, How to Grow Your Wealth and Live Off Your Investments. If you're dreaming of financial freedom and making your money work for you, you're in the right place. Did you know that Warren Buffett, one of the greatest investors of our time, started his investment journey at just 11 years old? And he famously said, "Someone is sitting in the shade today because someone planted a tree a long time ago." This series is about planting those trees for your financial future. We're not just talking theory here. We're diving into real strategies, sprinkled with success stories, and some lesser-known but fascinating insights. Think of it as a treasure map, guiding you to make smarter investment choices. Now, I bet you're wondering, can these tips really change my financial future? Well, stick around because in our final tips, I'll share a personal story that might just blow your mind. It's about a regular guy who turned a modest investment into a fortune, all thanks to these principles. In each tips, we're breaking down key strategies, from the power of starting early and investing regularly, to the art of diversifying and understanding risk. We'll explore why quality beats quantity in investments, and how tax-advantaged accounts can be your secret weapon. So, are you ready to embark on this journey? Let's unlock the secrets to growing your wealth and living off your investments. Trust me, you don't want to miss this. Tips 1. Start early and invest regularly. Hey there, welcome to our channel. Today we're diving into a topic close to my heart: building wealth through smart investing. First up, let's talk about starting early and investing regularly. You know, it's all about the magic of compounding. I started my investment journey in my early 20s. It wasn't much, just a few dollars each month. But here's the thing. Those tiny investments started to grow and grow. Compounding is like a snowball rolling down a hill. It starts small but gets massive over time. I remember reading about Sarah, a teacher who started investing just $100 a month from the age of 25. By the time she hit 65, her investments had grown to over $1 million. That's the power of starting early and sticking to it. The key here is consistency. Whether it's a small amount or a bit more, regularly putting money into your investments makes a huge difference. I'm not saying it's easy, especially when you're young and have a million other expenses, but even the smallest amount, invested consistently, can lead to significant growth over time. It's like planting a tree. You water it little by little, and one day, you're sitting in the shade of a mighty oak. That's what regular investing does to your wealth. It might seem slow at first, but patience pays off. Remember, it's not about timing the market. It's about time in the market. The longer your money is invested, the more time it has to grow. So start as early as you can and keep at it. You'll thank yourself in the future. Tips 2. Diversify your portfolio. Moving on to our second golden rule, diversify your portfolio. You've probably heard the saying, don't put all your eggs in one basket. Well, it's spot on when it comes to investing. Let me tell you about Mike. He invested heavily in technology stocks in the late 90s. Made a fortune, right? Well, not exactly. When the dot-com bubble burst, he lost nearly everything. That's a classic example of putting too many eggs in one basket. Diversification is your safety net. It's about spreading your investments across different asset classes like stocks, bonds, and real estate. And don't forget to diversify geographically too. Investing in different countries can protect you from region-specific risks. I diversified my portfolio over the years, and it's been a game changer. When the stock market dipped, my real estate investments held steady. It's like having a balanced diet for your finances. A well-diversified portfolio can handle market ups and downs much better. It helps in providing more stable returns over the long term. Sure, you might not hit that jackpot overnight, but you're also less likely to face devastating losses. It's not just about reducing risk, though. Diversification can also open up new opportunities for growth. Different markets and asset classes can thrive at different times. By diversifying, you're positioning yourself to capture growth wherever it happens. In short, diversifying your investments is like having a team of superheroes. Each one has its strengths, and together, they've got your back no matter what challenges the market throws at you. So, spread those investments and watch your portfolio become more resilient. Tips 3. Understand your risk tolerance. All right, let's jump into our third tips. This is a big one, folks. Knowing how much risk you can stomach is crucial in investing. Think about Alex, a friend of mine. In his 20s, Alex was all about high-risk investments. Cryptocurrencies, penny stocks, you name it. He was chasing big returns and sometimes he got them. But there were sleepless nights, let me tell you. Market dips gave him serious anxiety. As he grew older, his perspective shifted. He started leaning towards more stable investments, things like blue-chip stocks and bonds. Why? Because his risk tolerance changed. He wanted more predictability and less stress from his investments. Your investment strategy has to align with your comfort level with risk. If you're young, you might be more inclined to take risks for potentially higher returns. But if you're closer to retirement, you might prefer stability over high growth. It's all about balance. You don't want to be so risk-averse that your investments don't grow, but you also don't want to be constantly worried about losing your hard-earned money. Find that sweet spot where you're comfortable with your investments' ups and downs. I learned to assess my risk tolerance regularly. Life changes, and so does your capacity for risk. It's not a one-time thing. Regular check-ins with yourself are key to ensuring your investment strategy still fits your life. Tips 4. Educate yourself. This is non-negotiable. Staying informed is critical in the world of investing. I started off knowing very little, but I took the time to learn. I read books, followed financial news, and even took a few online courses. The more I learned, the better my investment choices became. Take compound interest, for instance. Understanding how it works was a game changer for me. It's not just about your initial investment. It's about the interest on that investment and then interest on the interest. Over time, it adds up in a big way. Diversification, risk-return trade-off, market trends, these aren't just buzzwords. They're concepts that can profoundly impact your investments. I made it a point to understand these, and it's made a world of difference. And it's not just about reading up on financial theories. Keep an eye on global economic trends. What's happening in the world economy affects your investments. The more informed you are, the better you can navigate these waters. I've seen people jump into investments without really understanding them. It's like driving a car in a foreign country without a map. You might get somewhere, but the chances of getting lost are high. In the end, knowledge is power. The more you know, the better your decisions will be. And in the world of investing, good decisions can make all the difference. If you found tips 4 enlightening, you'll love what's coming next. Subscribe now and keep up with all our wealth-building strategies and tips. Let's unlock the secrets of investing in quality assets together. Tips 5. Invest in quality assets. This is where we get a bit picky about where to put our money. It's not just about investing, it's about investing wisely. Let's talk stocks for a minute. Early in my investing journey, I was drawn to companies that were making headlines, but I learned the hard way that buzz doesn't always mean success. Now I focus on companies with strong fundamentals. Think solid management, consistent earnings, and growth potential. It's like choosing a marathon runner over a sprinter. You want endurance, not just a quick burst of speed. Real estate is another area where quality matters. I remember looking at properties in up-and-coming areas versus established neighborhoods. The difference? Long-term value. Prime locations may cost more upfront, but they also tend to appreciate more steadily. It's like buying a well-made car. It might cost more, but it lasts longer and gives fewer headaches. Quality applies to bonds, too. I look for bonds with good credit ratings. Sure, high-yield or junk bonds can be tempting with their higher returns, but they also come with higher risk of default. It's a bit like gambling. The stakes are high, but so is the risk of losing. Investing in quality assets might mean slower growth compared to high-risk, high-reward options, but it also means better sleep at night. It's about building a solid foundation for your portfolio that can weather economic storms. Tips 6. Utilize tax-advantaged accounts. Is all about a less talked about, but crucial aspect. Utilizing tax-advantaged accounts. This is where smart investing meets smart tax planning. If you're in the US, like me, you've got options like 401ks, IRAs, and HSAs. These accounts offer various tax benefits, which can significantly boost your investment growth over time. Think of them as power-ups in a video game. They can really level up your investing game. Take the 401k, for example. Contributions are tax-deferred, meaning you don't pay taxes on the money until you withdraw it in retirement. That can mean more money growing in your account. Plus, many employers offer a match, which is essentially free money. IRAs are another great tool. With a traditional IRA, you get tax-deferred growth, similar to a 401k. With a Roth IRA, you pay taxes upfront, but withdrawals in retirement are tax-free. It's like choosing between paying tax on the seed or the harvest. And let's not forget HSAs, which are like a hidden gem. They're designed for healthcare expenses, but they're also a powerful investment vehicle. Contributions are tax-deductible, growth is tax-free, and so are withdrawals for qualified medical expenses. These accounts are like the secret ingredients in a recipe. They can make a good investment strategy great. The key is to understand how they work and use them to your advantage. Remember, every country has different tax-advantaged options. So if you're not in the US, look into what's available in your country. Taking advantage of these can make a big difference in your wealth-building journey. Tip 7. Rebalance regularly. All right, let's dive into Tip 7. Rebalance regularly. This is where we do a bit of portfolio housekeeping. You see, over time, your investments can drift from their original targets. It's like having a garden. You need to tend to it, or it gets a bit wild. Rebalancing is about aligning your portfolio back to your intended asset allocation. Say you started with a 60-40 split between stocks and bonds. If stocks do well for a while, you might find yourself with a 70-30 split without even realizing it. That means more risk than you initially signed up for. I rebalance my portfolio annually. It's like an investment health checkup. 1 year, after a big stock market surge, my portfolio was way too stock-heavy. By rebalancing, I sold some stocks, at a high, which is great, and bought more bonds, getting back to my desired balance. It's not just about reducing risk, though. Rebalancing can also help you buy low and sell high. When you rebalance, you're often selling assets that have done well and buying those that haven't. It goes against our instincts. We're tempted to stick with the winners. But it's a smart move. Remember, rebalancing doesn't have to be complicated. Set a regular schedule, whether it's annually or after significant market movements. It's like regular maintenance for your car. It keeps everything running smoothly and prevents bigger issues down the line. Tips 8. Plan for withdrawals strategically. Finally, we reach Tips 8. Plan for withdrawals strategically. This is crucial if you're investing not just to grow wealth, but to live off your investments. Withdrawal strategy is all about how you take money out of your investments in retirement. It's a delicate balance. Withdraw too much, too fast, and you risk running out of money. Withdraw too little, and you might not enjoy your retirement as you deserve. There's a popular rule called the 4% rule. It suggests that you can withdraw 4% of your portfolio in the first year of retirement, and then adjust that amount for inflation each year. It's a guideline, not a one-size-fits-all solution, but it's a good starting point. I met a couple, Jim and Linda, who retired early. They had a solid investment portfolio, but they were worried about outliving their money. So, they worked with a financial advisor to tailor a withdrawal strategy that suited their needs and lifestyle. Your withdrawal plan should also consider tax implications and the order in which you withdraw from different accounts. For instance, in the US, it might make sense to withdraw from taxable accounts first, and then from tax-deferred or tax-free accounts. And don't forget about market conditions. Withdrawing during a market downturn can significantly impact your portfolio's longevity. Sometimes, it might be better to adjust your withdrawal rate or even postpone withdrawals if possible. Planning your withdrawal strategy is like planning a long journey. You need enough fuel, money, to last the whole trip, your retirement, considering both the expected and unexpected turns along the way. Conclusion. And that's a wrap on our series, 8 Investment Tips, How to Grow Your Wealth and Live Off Your Investments. I hope you found these insights both enlightening and empowering. Remember, investing isn't just for the wealthy, it's a path to becoming wealthy. So, what was your favorite tip? Which strategy are you excited to implement? Drop a comment below. I'd love to hear your thoughts and plans, and if you're still hungry for more, don't worry. We've got a treasure trove of content on wealth building, entrepreneurship, and financial freedom right here on our channel. So make sure to hit that subscribe button and turn on notifications. You won't want to miss what's coming next. Investing is a journey, and we're here to guide you every step of the way. From navigating market ups and downs to making smart, informed decisions, we've got you covered. Thanks for watching, and let's make your financial dreams a reality. Here's to growing your wealth and living the life you've always imagined.